All right. Good evening, everyone. My name is Yuling, and I am investment lead at Indawas. Thanks for joining us today for a session on Asian fixed income. Indawas has recently launched our service to Hong Kong investors too, so a special welcome to those who are tuning in from Hong Kong. And joining me today are two very special guests, Danny Tan, Head of Fixed Income from Eastspring, and Shilpa Singha, Credit Portfolio Manager from Schroders. The session today is really about them sharing their expertise and views on the Asian bond market. I am very excited to learn and hear from them, and I hope you are too. So before I give a quick introduction about Indawas for those who are not familiar, I am obliged by regulation to show the disclaimers for both Singapore and Hong Kong. Great. So who is Indawas and what does Indawas exist for? At the core of our mission, Indawas is here to empower individuals and families to thrive and achieve their goals. And we do it through superior advice and access delivered at a low fair cost, so you can invest better to live better. We're here to help you make better investment decisions and achieve better investment outcomes. We are a fee-only digital wealth advisory platform loved by many in Singapore and are bringing the same value proposition to Hong Kong investors too. In Singapore, we are the first digital advisor for all sources of money, including CPF, which is the pension scheme equivalent to Hong Kong's MPF. So what does fee only mean? It means we only serve your interest. The proof in the pudding is that we do not take commissions or kickbacks from selling fund managers' products, which is actually a very common practice in the industry for distributors to take a trailer kickback from fund management fee. And this creates two problems, right? The first problem is that this makes these players interest biased because they would want to earn more trailer fees instead of giving good advice and good product access to end investors. And the second problem is that it increases your investment costs because guess who is paying the trailer fees? It is you. The annual management fee will be bumped up to include the trailer fee kickback to the distributors. So here we don't take any commissions from our fund manager partners, and we only charge a platform fee from our end investors so that it is very transparent and we are completely aligned on the most fundamental level with our clients to serve their best interest. And we are backed by big global strategic and venture partners like UBS, Singapore Economic Development Board, Prosus, which is one of the largest technology investors in the world, and etc. And most of our employees are also shareholders of the company as we are all aligned and working towards the same vision. We are also very passionate about empowering financial education and literacy. And this is what we are here for today, actually. And with our resources and scale, we believe we can make an impact in this matter. And we have been consistently pursuing this mission through channels such as our Insights article and live webinars. And over the past year, we have had over 1 million unique views of our Insights article, as well as over 26,000 hours watched and over 15,000 attendees for the live webinar. So for today's webinar, we have a Q&A session at the end. Please post your questions using a Slido link, and we will try to address them as much as possible. And today's topic is on Asian fixed income. And it is our honor to have two very experienced investment professionals in this field with us, Shilpa from Schroders and Danny from Eastspring. Would you like to introduce yourselves first to the audience?
Yes, hi. Thanks, Yulin. My name is Shilpa Singha. I'm a credit portfolio manager with Schroders. I have 15 years of experience in Asia credit. I have worked for global investment banks as well as global fund managers, both in Hong Kong and Singapore, covering Asia, including Japan and Australia, and also parts of the emerging market corporate world.
Hi, thanks, Yuling. Hi, everyone. I'm Danny from Eastspring. I'm heading the fixed income team based in Singapore, and we manage a total of US 50 billion worth of assets. So that includes predominantly Asia fixed income. So with that, hand over back to Yuling.
Yeah, thanks for introducing yourself to the audience. And now my first question to you is, who are Schroders and Eastspring, and why should investors consider your Asian fixed income offerings? And Shilpa, would you like to start us off on this?
Sure, thank you, Yulin. So Schroders is a global fund manager. It's been around for more than 200 years serving clients. It manages nearly $900 billion in assets globally. We are a global fund manager, but we believe in managing through a local presence. So Schroders has been in Asia for a very long time, since 1998, and has a full suite of products in Asia, fixed income, covering Asian rates, currencies, as well as credit. It is also a very well-resourced strategy for us. We have more than 30 investment professionals based across offices in Asia, we manage more than 10 billion in Asian fixed income in the region, of which more than 5 billion is managed in the Asian credit strategies alone. So we do bring a lot of expertise and experience in this space. All our funds are also fully ESG integrated, and we believe in providing sustainable and excellent performance to our clients through our products. With that, I'll pass back to you.
Sorry, it's a bit hard to unmute myself somehow. Yeah, Danny, can you take us through Eastspring, please?
Okay, at Eastspring, like I mentioned earlier, we are probably best known by our parents, Prudential PLC, but in a sense, we have long established presence in Asia. So throughout all this, we have presence in key Asia local currency markets, and also obviously we have stuff like the Asian credit universe. So all like in terms of if you look at the slides on the awards, is it possible for you to share?
Yeah,
in terms of okay, sorry. So we have our house have won key awards in the respective areas, and obviously I think what investors have when they invest with us is really the significant access to significant scale of operations, and we have a well-experienced regarded team of 16 years on average experience, right? I think that's it.
All right, great. Thank you both. Now when it comes to Asian fixed income market, I believe what jumps to most people's mind most immediately is probably China, India, and Singapore, basically markets that are closer to us or have grabbed recent headlines. But the truth is that the whole Asian fixed income market is a lot more diverse than this. So Shilpa, could you please give us a more systematic overview of what Asian fixed income market actually entails?
Sure, happy to, Yulin. I put together the slide just to give an overview of the Asian credit market. This is just one piece of it. This is just the hard currency, or what we call the dollar bond market. And the slide on the left is quite telling, because it shows how large this market is. I think sometimes investors might not realize that the Asian dollar credit market alone is more than $1 trillion in size. It has grown more than 5 times in the last 15 years. And it is a very large investable market in itself. So the Asian dollar credit space is no longer a niche strategy, but a strategy which needs to be a critical piece of any investment portfolio from a diversification and liquidity perspective. The other telling point in the graph on the left is that it is a very high quality asset class. So if you see the green portion in that chart, investment grade is a meaningful proportion. In fact, currently it stands at nearly 85% of the overall $1 trillion. So we are talking about an overall investment universe, which is high quality and investment grade in credit quality. This has increased from about 2/3 about 5 years ago to 85%. So the Asian credit market is actually improving in credit quality. So investors in this space can expect to be invested not in low-rated space, but in a relatively high-quality space. If we look at the breakdown in the pie charts on the right, that gives you a bit of a flavor of what you would be investing in. And the key things that I want to flag out is that you're not really investing in a single country, even though China is a very big proportion of the country allocation in this space. That's natural given the lion's share of GDP that China contributes in the region. But the important thing is that there are many other countries in the region. Indonesia, Korea, India, Singapore, Malaysia are big contributors in the index. The good thing about investing in Asia credit is, as an investor, you would not just be investing in very developing or emerging markets, but you also have a choice of investing in more developed markets, such as Singapore, Malaysia. There is also the possibility to invest in markets such as Korea, Japan, Australia, which are not currently in the index, but form part of the investable universe. Even from a sector perspective, you would be investing not just in very sovereign or sovereign plus kind of universe, but you have a choice of sectors to invest in. So you can really tap into drivers of global growth when you are investing in Asian credit, be it industrials, metals and mining, but also utilities, consumer-led technology, utilities, real estate. So there really is a lot of diversification possibilities that you have when you invest in this asset class. With that, I'll pass back to you, Yulin.
Yeah, thanks, Shilpa. I think this is a great overview. I personally am quite, surprised by the percentage of investment grade in this universe. But on the other hand, I guess it also shows how Asian high yield is a relatively small part of the total Asian credit market, emphasizing the importance of diversifying that exposure with, probably IG. So great, thank you. And I guess most of us now will be curious about how the different parts of Asian bonds have performed. So Danny, I believe you prepared some remarks on it, and would you please take us through this part?
Yeah, hi, thanks, Yulin. So I guess the angle that we're presenting is that the Asian fixed income universe, other than the hard currency market, which Shilpa has actually highlighted. So I may point to that there's also a significant asset size found in the Asian local currency market, which is formed across the various markets. And one of which, if you look at in terms of performance, Asia local currency markets has actually outperformed the dollar market segment. Okay, so and if you look at within the Asian local currency segment, therein lies the Sing dollar component of it, which has even a greater performance. So meaning to say that in the concept that within the big universe or the opportunities that reside with Asian, that there's this potential segment for investors to gain access that is basically the local currency market, and more specifically, which we feel is liquid enough for the retail investors, is the Singapore dollar bond market, which which we'll talk about more later, right? And what we have observed over the years is that the local currency market, the respective markets, tend to be more lower beta versus the dollar market because of the fact that the holders are pretty resilient, and it's a niche investing market. And the importance of the local currency market will develop as the respective corporates realize the need to fund on an onshore basis as opposed to offshore. But that doesn't mean that it distracts from the greater universe of the dollar. It just means that it's just because of the economic growth of Asia on itself, there's a greater need to access all capital markets. So if you look at the slides, the slides following the performance, you will see that Singapore corporate bonds have been rather resilient over the years. Okay, so if you compare to over the past 2 years, since December 2021, you see it has significantly outperformed. Okay, and this is by the basis that the issuers in this market are really high quality, and there's been a lot of demand following Singapore as a perceived safe haven in terms of the currency market as well, and its AAA status. Okay. So with that, I hand over back to you, Yulin.
Yeah, thanks, Danny. Just to add I guess my observations, because it's really interesting. Shilpa mentioned about the Asian USD credit space, and just to summarize for the audience here, right? So essentially, we have the hard currency space, we have the local currency space. Within hard currency, there is investment grade and high yield. Within local currency, also you would have individual countries' local currency bonds like Sing dollar bonds, which Danny was speaking about. And it's interesting to see that last year when the US dollar bonds were hit quite hard, the local currency was a bit more resilient, and probably it's because they kind of follow a slightly different macroeconomic cycle. So while the rate was going up a lot in the US, which will hit the USD credit space in Asia, the local currency bonds together with its fundamentals would help to cushion that a bit and diversify the USD space a bit as well. And it's remarkable to also see the reversal of performance from 2022 to 2023. So yeah, I think next we will explore a bit more what is more forward-looking and what is affecting the Asian bond market now. And I think there's a lot of questions and concerns currently, right? By the investors, for example, where are we in the economic cycle? Are we expecting a recession? How will China's recovery influence the picture for Asia? So to both of you, actually, what are your perspectives? And yeah, Shilpa, can you start us off, please?
Sure, Yulin, and that's an excellent question, right? Because we've come into 2023 with relatively high interest rates, something that we have not seen since the global financial crisis, in fact. And it's very easy to throw the baby out with the bathwater and claim that Asia is part of emerging markets, and therefore, in a risk-off environment, how can Asia be a good place to invest? But I think there is a bit more, and it is worth looking at the details a little bit more, because compared to the global financial crisis, Asia has really changed a lot in the last 15 years. And that's quite evident when you simply look at the breakdown of global growth, as we show in this chart. Now that COVID is behind us, and we have entered a slightly more normal state of economic growth, we can see that Asia is a very big contributor of global GDP. In fact, by IMF estimates most recently, in the coming year, in 2023, Asia will be contributing more than 70% of GDP growth. That's quite evident if you look at the highlighted bar chart towards the right of this page, where emerging and developing Asia is growing at a much faster pace, not just compared to developed markets, but also compared to other emerging markets. And of this, we've taken out mainland China on the right, and it shows that China contributes to a lion's share of global growth. That is not surprising. We've seen that in the last decade, but it's important to note that China is coming out of COVID-0 period quite strong, and we expect very resilient growth in what is a very meaningful part of the Asian credit space. But I also want to bring attention to two other countries in the region, which are very big contributors of GDP beyond China. That's India and Indonesia. And we are entering 2023 with a very happy coincidence where all three economies are doing quite well, and quite contrary to the economic trends that we are seeing in the US and Europe. So not only is China coming out of COVID zero and therefore recovering quite fast, but India, which is a significantly domestically driven economy, is coming out of a credit down cycle of its own since 2012 and is actually on an extremely strong footing at this point. I actually went on a research trip recently to India to meet a number of the corporates across our investable universe. And it was surprising how consensus the view is that the balance sheets are under-levered. They are looking at growth. The domestic drivers of growth are really strong, and they are not pressured by the weaknesses which we see in the West, which is extremely high inflation or bank balance sheets, which are facing a bit more stress. So India will be more domestically driven and will be supporting growth in the region. And Indonesia also benefited when the developed markets came out of COVID and saw a strong recovery. So we saw Indonesia, including the local rates and FX in Indonesia, outperforming all of emerging markets as well, because it has come into this period of 2023 with a very strong external balance sheet as well as domestic drivers of growth. That is not to say that there are no risks. As I had mentioned earlier, Asia is a very diverse economy. There are export-oriented countries in the region, such as Korea or Taiwan, which will face weakness coming from slower demand in the US and Europe. We also have banks which have global linkages, so there will be some contagion from that. So we are looking at a period which will be volatile for risk assets in the coming days, but we feel that the fundamental drivers and the structural drivers of Asian growth and corporates are strong enough that they can weather this period of volatility much better than they could, for example, during the 2013 taper tantrum or during the global financial crisis. So Asia is likely to be an outperformer, not just relative to developed markets, but also relative to emerging markets in our view. And we are already seeing that in the performance of Asian credit. But we think that this trend will continue in the coming year because of the strong fundamentals and the ability of Asian corporates and financials to withstand this stress. So with that, I will pass on to Danny to share his thoughts.
Right. So just as what Shilpa has highlighted, that China, India, and Indonesia is expected to benefit from the recovery of COVID. So in a way, Singapore, I'd just like to highlight that Singapore being an economy, no surprises, have been reporting slowing economic data. But then again, on the investment front, or on that perspective, Singapore started being a safe haven, perceived as safe haven for private banking money since 2012. So in a way, you will see that the Singapore bond market will be a beneficiary of the high net worth individuals bring the investments over to Singapore. So from that front itself is that, what you're going to see is that the technicals is that Sing bond market, it will be a perceived safe haven from its perspective of AAA status, and also because how the Singapore dollar corporate bond market has developed since 2012, which is right now the bond market is probably about $300 billion US, and the access and liquidity, the trading is fantastic. So in a way that you will see that all these investors will come in and actually look to find a safe haven status here, and in a way that with the macro uncertainties, you will find that investors will want to flock here, use Singapore as a base, and then look to establish a presence elsewhere when the time emerges. And if you look, and that's precisely one of the reasons why, if you look at Sing dollar bond market, has been a lower beta versus the dollar market. So it all depends in terms of the opportunities to Asia fixed income market. If you look at the current situation, is that you can have the high IG market, the investment grade market in the US dollar universe, well as the low beta Sing dollar, which does not necessitate you a lower return, but it provides for people who do not want to gain to dollar volatility at the moment. Okay, so with that, I hand over to Yuling.
Yeah, thanks. Thanks both Shilpa and Danny. I think a lot of great insights from here, and you both kind of touched a bit upon what opportunity, where are you seeing opportunities? And actually, we prepared a dedicated session for that, right? Like just after this, and I think we can probably talk a bit more on the opportunity set, but let me just summarize for the audience as well. From what I heard is, Shilpa, you are saying that, you're seeing some strong growth opportunities in countries or regions that's more domestically driven, such as China, India, and Indonesia. And Danny, you were specifically talking about Singapore being the safe haven for investors in times of volatility. That's really interesting because when you think about safe haven, people usually think about the US, but I guess in a regional context, people do see Singapore as a stronger economy and more developed, and therefore come to buy Singapore bonds when they want to hide from volatility. So let's move on. And I think with everything you have said, is there any other opportunities or sectors or countries that you like? You can be a bit more specific to our audience, and how are you positioned in your portfolio as well? Because you're both portfolio managers, and yeah. And Shilpa, here you go. Yeah, please go ahead.
Yeah, so I thought we can start a bit more top down and then look at some of the sectors and subsegments that we like at the moment. And the one thing that stands out, and again, it's very easy to forget, is that we have not seen Asian credit dollar bonds offer the kind of discount that they do at this point. And we plotted a fairly long history on this chart to reflect this, breaking it up by US dollar investment grade as well as high yield in Asia. And as you can see, since the global financial crisis, bonds have not traded at the kind of discounts that they do currently. So if you are able to invest in the part of the market which can withstand defaults and which can offer you steady income, then you are likely to see a fairly strong upside emanating from this credit space. Between IG and high yield, we particularly like Asia investment grade at this point in the risk cycle. And as you can see, it's trading at nearly 11% discount at the moment. So there is a lot of value to be picked up by entering the market at this point in the cycle. And which are the parts of the market which we think will be a bit more resilient? For that, if we move on to the next slide, it highlights the parts of the market which have a lot more upside. So the first theme that we are investing in at the moment is the China growth recovery. That's an easy one because we have seen China give up the zero COVID strategy. When you combine that with some of the policy support we've seen come out of the Chinese government and regulators, there are a number of opportunities within China, be it airports, travel, car rentals, retail-oriented companies. We also like some of the technology and internet platforms, as well as selected property issuers who we see as survivors going forward, as well as the Macau gaming space in Greater China, which has seen a very strong recovery in its gross gaming revenues, especially during this week, which is the Golden Week. We have seen revenues improve to pre-COVID levels. So there is this strong tailwind in the Chinese recovery. And being in Asia credit, we have the opportunity to tap into that. given China contributes 40% of our investable universe, there are plenty of companies to choose from. The second theme that we like quite a bit is the financials, especially after some of the banking stress that has emanated from US and Europe. We have seen some of the repricing in the financial space relative to US banks, or especially the regional banks. The Asian banks are very well positioned, not just from a balance sheet strength perspective, but also from a asset liability management, or ALM, perspective. So we do not see them facing the same fundamental issues that are emanating in the US. And we also feel that there is a lot more support that is expected out of governments and regulators in the region, as we have seen emerge historically. So there is a lot of opportunity to pick up quality banks and large insurance companies, especially in the middle tier of subordination. So we are not looking at tier 1 space, which we are not constructive on at this point, but more at the senior, or senior preferred, non-preferred, as well as tier 2 space, where there are a lot of opportunities. There is definitely a lot more new issue concession that we can see in this market backdrop, and there is value there. And finally, just addressing the point around tighter financial conditions and credit conditions, which are emanating from the banking stress we are seeing in the US, as well as worries around US rates, as well as recession. We do think staying in more defensive sectors, such as utilities, as well as quasi-sovereigns from Southeast Asia, such as Indonesia or Korea, offer a lot of defensiveness to the portfolio. But the other thing to keep in mind is some of the risks that can emanate from this situation. So we are fairly careful around some of the leverage credits in the portfolio, as well as fallen angels. So these are companies which could fall from an investment grade rating to a high yield rating. So doing a more thorough analysis, just given the volatility, to be more nimble around that, are important strategies for us in the portfolio. So these are the main themes that we feel are the key investable ideas at this point. Back to you, Yulin.
Yeah, thank you, Shilpa. A lot of things to take away again. And I think actually this kind of addresses some of the questions that we have received on Slido, people asking about the real estate sector in China, and also Macau gaming, and I think SEA quasi-sovereign names, and these are kind of all mentioned also, although it's selective names in your presentation just now. So Danny, would you like to add on to it, and particularly from a local currency perspective?
Yeah, sure. So just reiterating the point on why Singapore bonds, if we turn on the slides on why, on the perspective of yields and the liquidity, you'll see that on a 10-year government bond basis, the Singapore government bond yields compare favorably across all the high investment grade sovereigns. Okay, so in that respect, there's no, it's sort of kind of hard to to ignore this AAA rated country with yields comparable to lesser rated countries. And then in terms of the resilience of this market is also for the fact, earlier on I mentioned about private banks, but if you look at the next slide, there's also a resilient demand for Singapore bonds on the long end from the insurance companies. So it has been increasing, it has been growing over the years. Okay, so in a way, there's in fact, I think if you use 2012 as a perspective, the market has actually grown in terms of the audience for this Singapore market. Has it reached its peak? The answer is probably not. And just like what Shilpa actually highlighted is that if the yields in Singapore has also been hitting his historic highs. So if you point back, like one of the points is that T-bills actually hit at one point hit 1988 high in terms of rates, which means that its rates are expected to decline some point later on. Yes, the answer is yes, because eventually interest rate cannot be kept, impossibly high because of the fact that there's only certain amount of damage that the economy can take before before they want to inflation to slow. The central banks to allow the central banks for it to slow down. In terms of credit diversity, say versus the Asian US dollar bond market, I think what happens that in the Sing bond market, you are seeing in terms of issuers that it's in a way relatively different from you still have an international issuers like the banks, the key European banks, and you have Singapore banks. The diversity is there in terms of the market, and on top of that, you have familiar names, blue chips names that you find on the Straits Times Index that's listed in their issue bonds. So all these are pretty, while some of them may not be rated, but you will notice that they are actually pretty high quality names that everyone can recognize with key leadership in their respective markets. So with that, hand over to you, Yulin.
Yeah, thanks both. Well, there's a lot of opportunities as we can see, and it's backed up by all of your charts and data. But of course, we can't ignore the risk because after all, Asian bond is still a risk asset. At this juncture, actually, before I let Shilpa and Danny to talk about the risk in Asian fixed income market, I would like to frame it for our investors first, and make two important points here. I think, first of all, to put Asian fixed income in context with other fixed income asset classes. So firstly, when compared with other segments of the emerging market bonds, Asian corporate bonds do have one of the best average credit quality. And but of course, the BBB+ average credit rating still reflects a decent amount of credit risk. It is investment grade rated, but almost at the lowest end of investment grade. And there is no escape of risk when investing in Asian credit. But the question that investors need to ask themselves is whether the market is offering sufficient reward for the risk. And from historical numbers, as well as the current duration yield characteristics of Asian credit, it does look like that, Asian credit market offers relatively strong risk-adjusted return potential. And now to put this asset class in context of other fixed income asset classes globally, so we plotted this risk spectrum chart of all the fixed income offerings on Indawas. The x-axis is the average 10-year volatility of all the funds on our platform that belong to the respective asset classes. And from left to right, we go from the lowest historical risk asset class to the highest. So the red dots represent different segments of Asian bonds. And the point I want to make here is Asian bonds can cater to different levels of risk tolerance. And you should think about how much risk you can take before choosing what part of Asian bonds you want to have exposure to. For example, if you're more conservative, then you can consider Asian short duration. If you have a longer investment horizon and higher risk tolerance, you can go further up the risk spectrum and opt for Asian investment grade credit to pick up the additional yields. If you are quite aggressive, then you can go for a blend of Asian IG, investment grade, and high yield, or even just go for Asian high yield standalone, but noting the level of volatility it has had historically. And I hope this gives you a framework to start thinking about allocating to Asian fixed income market or just fixed income in general. And now I'm going to, let Shilpa and Danny come back again and speaking more from a portfolio manager's perspective in terms of what risks you are seeing in Asian bond market and how are you navigating through. Shilpa.
Yes, thanks, Yulin. Yeah, I put together one slide, right? I mean, it's very easy to sort of get swept by all the headlines that we currently see. But when we get down to it and we think about it a little bit more, the crux of all the volatility and key risks at this point in the market is the high inflation, which all of us experienced, not just in Singapore, but globally last year and early part of this year, probably are still facing in a more moderated fashion this year. And as a result, a lot of central banks, including the US Fed, hiking rates at a very fast pace. So just taking stock of where we are at in terms of that inflation as well as rate story, the left chart shows where the headline US CPI or the inflation numbers are, consumer inflation numbers. And it's quite clear that the inflation, headline inflation has peaked and has started turning. However, we do see a lot of volatility so far into the year in 2023, which is emanating from core services within the US, which are still seeing relatively high price increases, and therefore the worry that inflation in the US will remain sticky. Why is that a problem? Because central banks may struggle to reduce rates or stop increasing rates, including the Fed, if this inflation remains sticky. What the market has increasingly started pricing because of some of the banking stress that emerged from these high rates is that the US central bank will have to start cutting in rates, which is what we show on the slide on the chart on the right. So the market, for example, is already starting to price in a reasonable probability that there could be 2 rate cuts in the second half of this year. We are really at a watershed or a turning point, I think, in when it comes to both inflation and rates. And this, I think, offers an excellent opportunity to look at fixed income, especially high quality fixed income at this point, because if the central banks do turn and if inflation does turn, then rates could decline. So you would not be able to lock in the high rates. But you do run the risk that if inflation remains sticky, then rates could remain high. To us, whether rates remain high or start declining, either way, an investor in Asian fixed income, especially higher quality Asian credit, can benefit from this environment, because not only will you be locking in relatively high income return, but you can also benefit from spread compression, be it from treasuries or credit spreads in the coming 1 to 2 years. So this does offer a very unique entry point from our perspective, but it is a bumpy road. So there will be a lot of volatility. It is important to navigate this period carefully. There will be headline news, there will be risk-off periods. So we do feel that it is important to stay diversified and liquid in your portfolios, do relatively careful credit selection, and be nimble around both duration positioning as well as credit selection. So that would be our advice when it comes to navigating what is going to be a volatile but rather rewarding period of investing ahead. Back to you, Yulin.
Yeah, Danny, what are your thoughts?
Okay, Yulin, if I may point towards the previous 2 slides, fundamentals remain, the one that's headline fundamentals remain intact. Okay, so from the perspective that with interest rate at record highs right now, so it's pretty interesting that we can actually get decent returns from investing in high quality credits, right? So if you look at on the left hand side, the total debt to assets of US versus Asian companies, you will notice that Asian companies in general, using debt to asset as a measure, is very much less leverage, okay, versus US companies. And what's even more interesting is that Singapore companies are even lower geared. So if from that perspective is to say that be it whether you invest in Asia investment grade companies or you're generally the safety is there. And where I'm coming from is that, okay, so with all the rate hikes that's been effected, we are seeing signs of slowing down job losses, and eventually that may lead to a recession. So obviously we got to be careful, keeping it in the back of our minds that that with all these negative headlines, plus the tightening of the banking system in the US, this may lead to recession, and there could be negative impacts in terms of the small medium enterprises. So from that perspective alone, we just got to take a measured approach to just jumping into say the lower quality assets at the moment. We need to measure what's happening. But if you were to take the perspective that you will just go into high investment grade stuff, I think it's a great opportunity. But obviously, what Shilpa has said, it's a bumpy ride. But I think it's something that's worth for the investors to consider going forward, because I think you won't get to see a lot of such opportunities on this current perspective. Okay.
Great, thank you, Danny.
And sorry, just to add, if I may, the following slide in terms of the relative stability of Singapore bond market, you will see that all throughout this period, the Singapore bond market has actually sort of delivered rather stable returns.
Yeah, great. Okay, I think I hope investors, would have gotten a relatively good idea in terms of how to navigate. And I think, to be honest, I think we still need to rely on your, fund manager's expertise to help us navigate through it, because credit selection is definitely very key, right? And as Shilpa, you mentioned, being nimble in terms of duration and quality exposure is very difficult for ourselves to do. Like, you have to watch the market every day, have your views updated in terms of the trajectory of interest rates and etc. So yeah, I think these are really important points to note. And lastly, the last question that we have before we go into Q&A is how can Asian fixed income fit into an investor's portfolio? I think I will let Shilpa talk about it first. And there is actually a question from Slido asking whether Asian fixed income is suitable for retirees. So if you and Danny have any thoughts on this, feel free to address it here as well.
Yeah, great. Thanks, Yulin. And it's a very important question, because whether we invest for our clients or whether we invest for ourselves, that's one of the key reasons why we are investing, right? We want to think about it from a more medium and longer term. Populations across Asia and Singapore are aging. The need for income is fairly central in our investing process. And I do feel that Asian fixed income, Asian credit fits in very nicely to provide you with a stable income while providing you with some upside, especially capturing some of the growth and transition opportunities that a region like Asia, offers. So I put together the slide because it specifically addresses that question. On the left, there is the investment grade. It's a fairly simple slide. On the x-axis, you have the duration of the asset class, and on the Y, you see the yield, and we broke it up again by investment grade and high yield, given how different the composition and risk buckets for these two sub-asset classes are. The one thing that stands out is how much the yield for Asian investment grade corporates has increased from December 2021 until now. So it's really less than 1.5 years ago that you could make only 2.5%, if that, from taking on Asian investment grade risk, and a lot lower actually in US IG and US Treasuries. But in less than 1.5 years, the yield capture that you can have by investing in a relatively high quality asset class has doubled. So you're getting more than 5% for around 5 years or lower duration in your portfolio. This is investment grade, so there's relatively low default risk, if not zero. This is fixed income bonds, so you get a regular income which you can harvest from this asset class. On the right, we also show the increase for high yield. So of course, you can get double-digit yields in Asia high yield. With the right credit selection, there is a lot of return to be made in this sub-asset class as well. Combining investment grade and high yield through a blended route can also be a good investment options. But one needs to be mindful that in the upcoming volatile period, risk in high yield will be higher. There will be risk of higher markdowns in bonds. There is also higher default risk. So there is a greater need for risk assessment in high yield in the upcoming 6 to 12 months. Having said that, it's still an attractive space, offering you more than offering you double-digit yields for relatively short duration. But at this point, I think especially if you're looking at safe income-driven investing, then Asia investment grade does offer a very good spot. If we move on to the next slide, there is another question that we get sometimes from our clients. Why should we not just invest in US dollar deposits? Why should we invest in Asian investment grade, especially with rates have gone up so much? Deposits can also offer us a high yield, which is true. But if you look at the blue bars, which we have compared against the green bars, which is the deposit rate, you'll see that the dark blue portion of the blue bars is the income portion. So this is the coupons that you will harvest, also for a 5-year asset. And the light shaded blue bars is the price return that you can make when spread compression happens, especially on the right. You see, if let's say there's a 50 basis point spread compression, you can also gain from the price return from this asset class. Given that bond spreads have widened due to the volatility from US Treasuries, from the banking stress, this point does offer an attractive entry point for this asset class, where you can not just harvest income, but you can also harvest price return. Even from a downside perspective, even if there's credit spread widening, the high overall yield of this asset class protects you from negative total return as well. So from a risk reward perspective, it does offer investors a very attractive opportunity in our view. Yeah, but that's all the comments I have on this. I'll pass back to you, Yulin. Thanks.
Yeah, great. Danny, do you have anything else to add? And actually, I have a question from Slido, which I think you can probably address. And the question is, given this, why is there any advantage for investors to buy Asian fixed income versus just getting government issued securities like Singapore savings bond or T-bills?
Right. So understand the point raised. So it's a similar question on like why buy US Treasury, because the current interest rate environment is a reflection of how the central bank is hiking. But again, like I mentioned, interest rate pressures to reduce inflation, it's only a temporary situation. It's not long term. Meaning to say that eventually the man on the street will actually feel the pain via the increased mortgage costs and so forth, and companies will actually differ in terms of their perspective of like funding projects with leverage, and this will ultimately cause a slowdown and job losses, right? So with that, the government at some point will have to consider cutting interest rate to more manageable levels, because if that causes a pain on the man on the street, rates will not be persistently high for a long time. So meaning to say, yes, for all investors right now, it's good that we get high T-bills and all those, but on a longer term basis, because our earning cycle, our life cycle is more than just this couple of years, so it's worth considering that, from an asset allocation type of perspective, bonds being, part of the allocation on a total, other than equities, bonds is an essential component to the end investors. As they get older, like Shilpa mentioned, it's income driven. So, if you invest in a basket of equities, you get uncertainty with regards to the capital movement. You do not know at what point. Whereas with regards to bond investments, you will see that in most bond funds, you will see that the NAV is always upward accreting over the period of years. And the fact that it makes sense that why the government bonds, again, like I mentioned, we probably last saw T-bills at probably the record highs, hitting record highs in 1988. But if you look at it, that was some time back, and it's not in each period. Unfortunately, I don't have the charts to show, but it will show that the period of interest rate, the sustain at these key government bonds is not sustainable. It will eventually come down. And what happens in this current period, you see opportunities like the charts that both companies have shown, is that there's opportunity for you to lock in all these high quality securities at decent rates. So, and something that may not be appreciated right now, but the moment interest rate starts to be cut, you will see the potential capital appreciation. But then again, I will tell the end investors, do not let this distract you, because what you have locked in is actually valuable carry, which will prove to be valuable in years to come. So if you look at the perspective that all of us, the world is aging, from a life cycle perspective, investors ought to be increasing their allocation to fixed income over time, probably slowly over a period of 5 years. But if you look at the situation, is that why bond funds rather than why do I not buy bonds individually? Because you will realize that other than Singapore savings bonds, which is a very unique feature that the Singapore government has actually put in place to encourage people to diversify from the usual asset class that they have, you will see that buying bond funds, be it whichever currency, allows the investors access to probably 100, 200 securities and liquid, and they did not deal with the banks to sell the bonds, which may not be which at a certain point may not be liquid to them. So that's the perspective I'm offering, because to the investors, because think of it, the game is a regular savings plan over the longer term rather than what we see right now.
Thank you, Danny. I think that's quite helpful. And I think from my perspective, I was just checking the latest yield on the Singapore savings bond, right? It's not that high, to be honest, compared to the yield currently offered by, for example, Asian IG, which is already over 6%. The 10-year Singapore savings bond is at 2.8% by the latest issue. Of course, there is a risk and return trade-off. You pick up a bit more risk by going to Asian investment grade, whereas the Singapore savings bond obviously is a lot safer. So I think ultimately it's also your choice in terms of how much income you need actually, and how much risk you can take at this moment. I know we're running up on time, and I'll just finish up this session by providing a longer term perspective in terms of asset allocation and how you should think about Asian credit in light of all the other asset classes that's available. And my suggestion for everyone is, it is no matter how attractive one single market looks now, it is still advisable to consider diversifying your exposure. The reason is because it is very difficult to predict which market will be the best performer in the next few years. And I think this color code chart shows it really well. Different color blocks represent different fixed income markets. And year on year, there is no consistent top performer. It is almost random. So, going back to, I think, the risk map that I showed just now, once you understand your risk tolerance, well, you can find one Asian fixed income segment that probably will fit your risk tolerance. You see there's also a lot more other options around the same risk level too. So why not consider diversifying your exposure to Asia with other asset classes and potentially making your exposure more global? And lastly, just one final point on diversification. You can diversify your bond holdings with equity holdings. They are historically very good diversifiers to each other. And the chart shows it well by plotting the annual performance of bonds on the x-axis and equities on the y-axis for the past 50 years also. And for most of the time, you see that the dots are on the top right the quadrant. That means that both bonds and equities delivered positive return for the year, or if they are on the second and fourth quadrant, it means that delivering diversifying return, the returns were in opposite direction for that year. I know it doesn't feel like, diversification really matters because all we want is just positive return, right? But just imagine when the equity market goes down by like 50% in 2008, that positive cushion from bond is going to help you a lot to go through that tough period of time. But of course, I think in terms of how much you should allocate to bonds versus equities, it depends on your risk. Equities will be a lot higher risk. So I think Danny mentioned before, as you get a bit older, your earning power decreases and you're planning for retirement, you probably want to allocate more to bonds than equities. But when you're younger, you can do more equities than bonds. But I think the bottom line is think about diversification. And think about the opportunities you can capture now in fixed income. And the presentation ends here. We don't have a terribly amount of questions on Slido, to be honest, and I think we have addressed most of them. I believe both Shilpa and Danny are okay to stay on for maybe another 3-4 minutes. So why don't we give it 1 more minute to see whether anyone has any questions at this moment before we end off. And while waiting, actually, let me show the Slido link again so that people know where to go at the front. Yeah, here you go. And while waiting, maybe just one question for you, and that is, I think someone asked about aging population for China. Do you have any perspective on how this will affect the long-term dynamics of the China fixed income or China economy overall?
Yeah, maybe I can start, Yulin, and then pass to Danny. Populations are aging around the world, and China is no exception. And aging population is a structural shift. But even though it's aging from where it was 5 or 10 years ago, China still is a very young population compared to, say, parts of Europe or or Japan, for example. So this is a shift which is happening, and it's a structural shift. But there are also growth drivers which offset that. So improvements in productivity, for example, which are coming through technology and other sectors, be it sustainability and environment related, such as batteries or EV. So there are a lot of growth segments that can be captured and which can drive productivity in these economies, even though labor populations are aging. So that will shift, for example, how people save and invest. It will affect segments such as real estate, or the type of real estate that the Chinese population demands. But having said that, there will still be a demand for housing in the real estate segment. There will still be a demand for replacement housing. So it's possible that segments such as real estate will not see the kind of growth they saw in the last 20 years. However, they will still face steady growth in the coming 5, 10, 15 years. So the down cycle that we are seeing in China real estate, for example, is more cyclical in our view, and will come back as the companies in the space are able to manage their leverage, deleverage, clean out their balance sheets a bit. Similarly, we do see a lot of opportunity for the economy to transition away from more industrial segments towards more value-added segments, be it technology, I mentioned environment, and there can be many other new segments there. There will be a lot of investment opportunities there. So while aging population is a structural trend, including in a place like China, it by no means suggests that it's a declining or slowing economy. We do feel that there will be a lot of growth drivers. There'll be newer segments to invest in the coming decades, in fact. So it's really a very long-term structural theme, in my opinion.
Yeah, and as population ages, the opportunities such as medical equipment and healthcare also.
Yes.
Danny, it looks like you want to say something.
No. So just adding to the perspective, I guess, aging population, in my view, maybe it's probably I'm an outlier, but I think that from the perspective, we are trying to apply the trends of the past in terms of what aging means. But I think if you have technology developing and stuff like that, people leading a better quality of life, it doesn't mean that, to be honest, that with all the technology there is to make up for the loss of human labor in terms of hands, but it may not be the bearish scenario that a lot of people think. But I think what happens in China, I think what Shilpa said, is that probably it's a longer term theme, but then again, what the thing we should not miss is the growing affluence of the Chinese population. I mean, it's so much that given what's happened on the Chinese real estate, but remember, China is still a place with a lot of affluence. People are still getting richer in general, and the government's push to actually to reduce the income gap prosperity, actually that represents a lot of opportunities, still in this country.
Yeah, that's great. I'm proud because I'm Chinese. Joking, yeah, but I do see the economy recovering and a lot of new things coming up, and it's quite amazing to witness that. Okay, I think we are actually well over time, and thanks so much for spending time with us and our audience today. Please have a good evening. And everyone who stayed with us as well, thank you for joining us today again. And we wish you a very good evening ahead.
Thank you, Yulin. It was a pleasure.
Thank you.